So, what causes the market prices to go up and down? The markets are influenced by the economic and business changes. So, market rises as the increasing economic growth, while fears and decline business activity, and thus economy whole causes stock value to rise fall. So, so what they do is the market shows the anticipation of the future economic activity or business activity. So when they are good forecast about the rising economic activity and business activity, the stocks tends to do well better. But if there is a fear, if there is a war, it's a pandemic, or something internal conflict going on, it leads to not doing well of business activities, and it will stocks will fall. So both market and economic are both in continuous direction of motion, so that they not find stable. This causes the market to be so volatile. When thus combined with different sectors move from construction to expansion and back to contraction, while that other hand economic moves from contraction to expansion and back to contraction, this combination of economics and business activities tends to keep the price go up and down. What is the thing we need to note down is these keep happening repeated over and over again, so we can find patterns, and we should understand this better. So what causes this prices rise and fall and business activities to construction and expansion is the main cause is the interest rate. So what causes the interest rate to go on up? It's the inflation. The interest rate is there to control the inflation. So when the interest rate are increased, it leads to lowering of economic activities. So when the interest rate are lower in the beginning times, what will happen? The interest rate will be lower, so the business produce too much production, and wait for hopes for a future sale. So after that initial sale and the sales started to stung after that uh, after that rise in sale, what happens is there will be no expansion of the company, because they have produced so much. They need to clear all those inventory to produce more. So the inventory is until the inventory is exhausted, the businesses don't need capital. So as I say, that interest rate and economic activities are lowered, so you can see a high pickup in industries like homes and automobiles, like cars and bikes, vans, etc. So all consumer centric sectors also perform well at these times. So as there are more debt at low interest rate is available, the capital expenditure, as the sectors such as capital goods and commodities and metal might struggle at first, because there is more purchasing of it. The commodity price is lower and the purchase is smaller, so the commodity price will increase. As the capacity expansion increases, the price of the commodities also increases. That leads to an inflation point. Then the interest rate will be raised to control the inflation. This causes the interest rate sensitive sector to fall. And on the other side of the coin, the financial service, the debt service, and the consumer facing interruptions and the retail consumption sectors do well because of the rising interest rate. So this is the chart. This is the simple chart of expansion phase and construction phase. When the interest rate, when the in the starting of the economic cycle, the Q1, the interest rate are lower, so it boosts up the production, and after that rise in inflation, the interest rate are higher, so that the sales stop. tells us the increase in interest rate does not boost up the future uh, future business production. So after the sales up, it goes to downward, and again the interest rate is lowered and boosting up the production, and after the production is over, that's just it comes down. So this is continuously happening right here. We are talking about not foods, grains. We are talking about the industrial matter over here. So this lasts anywhere from 3 to 5 years. So what happens is that if after that low economic, the tends to peak, have a long period of 3 to 5 years. If the we as a trader we have must know the importance of sectors like banks and technology. When there is a lower interest rate, these stocks, banks and technology stocks, tends to fall more. These stocks have a huge index weightage, so it is not a good idea to hold them at that time. We need to sell these stocks.